RVNL surges as it wins a near 200 crore order coming in from metro stations of Nagpur. 6 elevated stations is what they will construct.
Mahindra is a top loser on the Nifty, trading with losses of over 5% after it cuts prices of its XU7 700 model by 10%. Auto sales have also been under pressure for the month of June.
There's a big block deal in Mankind Pharma sees about 1% equity worth nearly 800 crore rupees change hands. An affiliate of the Capital Group is likely to have sold stake.
MK Pharmaceuticals and Bansal Wires, both of them see a strong debut on Street, listing with gains of around 30 to around 35%. Hello and welcome to Chartbusters. I'm Nigel D'Souza. Joining me as always is Mangalam Malu, and a bit of a rarity today actually. After a while, all the top indices that you see, well, all of them are trading in the red, when one would have said, we told you so, but actually many of them have been telling us so for a while right now. However, we have down close to around 200 points on the Nifty. The Nifty Bank is down 350 points, actually is doing a relative outperformance. But your portfolio will not be feeling too good because of the broader markets. The small cap and the mid cap indices, both of them are seeing exaggerated cuts in today's session.
Absolutely, Nigel. You know, yesterday there was a record high and there were a couple of red flags already. But then again, those red flags have been there for a while. One was just waiting. The question is whether we see support from earlier levels of close to around 24,150, 24,200 or not. Because as the market moved higher, the put writers continued to move higher as well. So those would have immediately unwound their positions as we speak right now at the low point of trade for all the frontline indices. And we are seeing some cuts in a lot of these index-heavy names as well. So all of them should come up for you as we speak. We have something like an HDFC Bank not particularly doing too well. And, the realty stocks are losing as well. PSU stocks and the metals index, all of them actually lower in today's trading session. Let's see where we go from here. The advanced decline, like Nigel said earlier, 2,000 stocks in the red for about 340 stocks in the green. The lines are as far and wide as they can be, with the red line much above the green line right now, wide. There was an opening positivity. Thereafter, there was a crisscross and a big up move for the red line, that is. But Nigel, you're looking at JSW Steel for its production data that came in?
Well, that's right. It was par for the course, actually, Mangalam. There was a bit of a decline. If you look at the consolidated sales, which should come up for you in the screen, consolidated would be the India operations as well as the US and the European operations. So out there was a bit of a decline that we saw. On the India business itself, I think we'll get those graphics on the screen at some point of time. On the India business as well, on a year-on-year basis, it was down by close to around 1% odd, came in at around 6.12 million tons. And as that play tells you, the street really focuses on the domestic sales. Now, but there was a bit of a shutdown that we saw, and that was a maintenance shutdown, which the street was aware of as well. So that explains why the volumes are a little bit lower in terms of production. Also, they've gone and given up their utilization levels at around 87% odd. What works for JSW Steel is, since they've been adding capacities, the next couple of years, you'll see volume growth out there. However, since we're in a monsoon season, pricing is a little bit weak, and that's on expected lines. In monsoons, you can't get a price increase that comes about. So that's why the stock is down close to 100%, but the entire market is down more than 1%. So I guess, stock not really reacting to those numbers, but reacting to sentiment.
Absolutely. Let's talk about Delta Corp as well. That's the one that I'm watching out for. First quarter typically not very strong seasonally. And to add to that, this quarter was marked by a couple of things that happened as well. The first important thing was that, this is also the first quarter from the last September to now where we had the higher GST coming in. So that was impacting their performance. Add to that, there were elections. So there was restriction of movement, etc. And heat wave, severe heat wave that impacted tourism itself in general, and that's something that Puneet Chhatwal said to us on CNBC-TV18 yesterday as well. Add to all of this, there was additional weakness in the online skill giving business. So the company had to provide for higher customer incentives that led to net revenue for the company itself. So revenue overall from last year to now declined by 30%. And because this is, a big decline in the revenue, that had an even bigger decline in their EBITDA. 68% cut is what we saw. So the margins compressed from about 37% to about 17% itself. And as a result of which, the net profit was down 70% as well. Casino business, that showed a revenue decline of 25%. EBIT was down by almost 60%. Online gaming, this is net of incentives, actually declined by 90%. So just 2.5 crores versus 23 crores is, what the company reported in terms of revenue. And the EBIT loss also increased from 8 crore to about 18 crore. Hospitality, we spoke about tourism not doing too well. that was down 17% on a reported revenue basis as well. So all these factors not particularly working for Delta. And if you look at the last few trading sessions as well, there was a bit of an up move that we saw in the stock. So that is something that is coming undone. But in an otherwise weak market, KDDL is the one which is actually mildly higher because of the buyback announcement that came by. So let's see where that goes. But that's about individual stocks. Let's get in Soni Patnaik joining in from JM Financial Services for a quick technical check on the market. Soni, typically we ask you how high is this going to go, but today after a 230, 240 point low on the Nifty right now, we're on the verge of breaking that 24,200 mark as well. The question is, where does support come in now?
Good morning, Mangalam. Good morning, Nigel. Thank you for having me on the show. So I think the correction was quite expected because, both the indices had actually touched an overbought zone and there was a expectation that it can correct. The correction for Nifty, any level below 24,200, you can see 24,000 levels also getting tested. Now, that is going to be the area where it will test itself because it's a very crucial support for the entire series. If 24,000 support breaks, you can see the correction getting extended towards 23,700 plus levels. I think that is where level one can actually watch out for. But of course, from current level from 24,400, 24,450 is going to act as a resistance. There's a lot of significant call writing that can be seen in today's option chain metrics. So I think that's the level to watch out for. Intraday basis 24,200. Any break below that, it's going to take us straight to 24,000. Similarly, for Bank Nifty, 52,000 is playing a very crucial support level. If that level were to break for Bank Nifty, we can see the profit booking taking place up to 51,000, 50,800 levels for Bank Nifty. So I think that is very crucial. I think Bank Nifty also has started showing the first signs of correction and it can test 51,000 support.
Okay, got it. Soni, what about individual stocks? What are you looking at?
Nigel, so it would be both on the sell side for the day. One we can see in ABB futures, which is looking quite weak. It has given a fresh breakdown below 8,600. There's a lot of put open interest unwinding seen at lower levels. So the support is getting weaker. So in futures, one can sell ABB, keeping a stop loss of 8,630 and a target of 8,400, 8,350 levels can be seen. The other idea to balance out the approach would be on a buy. However, the buy comes in Asian Paints, but it's a buy on dips. So anywhere towards 2880, 2870 is the level one can buy on dips for Asian Paints, keeping a stop loss of 2840 and a target of 2930, 2950 can be seen.
All right, Soni, thank you for joining in and giving us your calls on the stock as well as the indices. 51,000 on the Nifty Bank, 24,000 on the Nifty are levels that can be tested in the kind of ferocity that we're seeing selling with. In fact, from the time we started the show to now, there has been a 30-40 point decline in the Nifty already. The Nifty has broken that 24,000 mark as well. So it is a big gash that we're seeing. And the Midcap index down about 2% as well. In a market like this, what are the kind of ideas for profit there are? We have our colleagues from Money Control Pro joining in and telling you that. We have with us Lekha Badlani Jamnani joining in.
So the stock pick is Apollo Hospitals, which has been an underperformer amongst its healthcare peers in the past 1 year. Now much of this could be attributed to the concerns attached to its Apollo 24/7 business. Now, the company was expecting its healthcare vertical to achieve EBITDA break-even in Q4 FY24. However, it broke even in Q3 itself. Now, the offline pharmacy business remains steady and profitable. Also, the management is confident about achieving EBITDA break-even in its Apollo 24/7 digital business in the next 6 to 8 quarters. Additionally, the merger of KeyMed with its healthcare business is likely to make it one of the largest integrated healthcare providers. Now, the management has guided for the combined entity to clock a revenue of 25,000 crore by FY27 with an operating margin of 7 to 8%. For FY25, the management is guiding for 15% revenue growth and 25% EBITDA margin for its hospital business. Its expansion plans for FY25 to 27 is well in place to drive growth in the coming years. The diagnostic business also continues to scale up well as its revenue and EBITDA grew 20% and 76% in FY24. Now, Apollo Hospitals has the potential to leverage its presence across the entire spectrum of hospitals, pharmacy and diagnostic segment. Furthermore, improving pharmacy business appears as a turnaround opportunity for the stock. Trading at a reasonable valuation of 23x FY26 estimated EV/EBITDA, we recommend accumulating the stock for the long term.
All right, with that, we'll take a short break, come back on the other side, get you more on the markets. There has been a deep gash. We'll get you some more market opinion and stock-specific action as you come back after this short break. Well, we are seeing some bigger cuts now in some of these names. So pull up something like, an Atul Auto, which had seen a big move earlier, now currently at a lower level. Park Hotels, all the hotel stocks have been doing well. Now some profit taking for this one. Castrol India, that's the other one that saw a big move earlier. That's also at the low point of trade. So we are seeing some gashes in a few names. And then from, the F&O pack, we have GAIL, which is at the low point. We have NCC, which is at the low point. NBCC, Bandhan Bank. There are a lot of stocks which are now actually testing the lows of the session, with the Nifty, sitting with a cut of almost 1% and nearly twice of that for the Midcap index at 2% as well. But amidst this, there are some brokerage ideas that have come by as well. Supreme Industries is one on which Jefferies has written. Sudarshan joins in to tell us more about that. Sudarshan.
So the stock is trading lower as overall market condition is not favorable for any of the, most of the stocks are trading with cuts today. But Jefferies maintains buy call on the stock, and it has raised target price to more than rupees 6,700 from rupees 5,390 per share. And the rationale that company gives, Jefferies gives, in April-May, volumes have grown by 22% year-on-year despite a high base, and sales have grown by 12% impacted by PVC volatility, and focus on value-added sales might aid the margin for the company, and SKU breadth and distribution depth act as key modes for share gains that company might have in the next few quarters. And Jefferies believes it will be a good play on housing, capex and agri. It estimates 25% plus EPS CAGR over FY 24-27.
Thanks a lot for that, Sudarshan. Well, let's focus on the other stock, MGL. That was the one that was buzzing in trade today. The company has hiked the CNG prices by around 1 rupee 50 paise per kg and around 1 rupee per SCM for PNG. The company says the price hike was due to the shortfall in domestic gas allocation. Earlier today, we spoke to Mr. Shingal, the MD at the company. Let's listen in to excerpts of that conversation.
We were getting APM gas, which is at $6.50. From 82%, it has come down to 68%. So there is substantial reduction in the APM gas, which is the domestically available cheap gas. And the LNG prices were earlier down, but now it has started increasing again. So we are constrained to increase 1.5 rupees in the CNG prices. However, still we are the cheapest in the country in terms of CNG prices and PNG prices. The per bike consumption, the cylinder capacity is only 2 kg. So to see any significant increase in our volumes, the number of bikes should be very huge. So it will take some time. Maybe next year we will get some volume, maybe 2-3%, and afterwards it can increase furthermore. But definitely it will take some time to, one, that people are getting used to the new bike, although it is definitely much more advantageous in terms of running cost. So double the numbers will give us maybe 10% volume, but then the numbers of bikes should be around 7-8 lakhs, which will take a substantial period to come to that number in Mumbai or in our geographical areas. The budget is passed and what is included in the budget or not. The other point which we are hearing is maybe the gas can be included in GST, because if that so happens, then excise duty cut will not be required. It will be one tax regime for the gas segment itself.
Okay, all right. Let's focus on a couple of stocks that are buzzing around. RVNL, in the first hour of trade, the volumes were massive. And I think even though the markets are at the low point of the day, that's still holding with a gain of around 5.5%. Vivek joins us to fill us in with a quick analysis on the news flow. Vivek?
Well, that's right. So railway stocks, despite the market fall, yesterday, of course, they did correct from the day's high yesterday. But today, once again, especially RVNL on the back of some positive news flow, is again trading in the green despite the kind of weakness that we see in the overall markets. So what is the development that's happened? Some time ago, there were talks that India, will be participating in going ahead and developing a Middle East railway corridor. And there has been some progress made on that front. So what has RVNL done? As of this point of time, it's still an MOU. That's a memorandum of understanding. RVNL has signed an MOU with Tatweer Middle East and Africa LLC. So what will be RVNL's role in this particular MOU? They will be using RVNL's expertise in the railway sector for joint design and execution of various rail-based work in the MENA region as well as other European countries. Some more positive news are coming in for RVNL. This is for the Nagpur Metro in Maharashtra. The company has received the letter of award for construction of 6 elevated metro stations. This particular order size is in excess of 187 crore. The time period for this particular construction is around 30 months.
All right, Vivek, thanks a lot for that. So that's about RVNL. The last couple of trading sessions, we saw some profits coming off, but one order win and, the railway train starts once again up 6% now in an otherwise wobbly market. But what a good listing for, Bansal Wire in this environment, Nigel.
Well, that's right, Mangalam. Bansal Wires, so there's a fair bit of interest on that particular counter, and it's opened up with a gain of around 30% odd. Let's run you through a few details. If you analyze last year's EPS, they did an EPS of closure around a little over 6 rupees per share. Now, given that it's listed at a premium of close to around 35-40% odd, the stock is trading at around 50 to around 55 times its trailing earnings. However, the earnings will improve going ahead. Why is that? Because remember, this wasn't an OFS, it was a fresh issue, which means all the money comes back to the company. So how does that help? Let's get some points up on the screen as well. How does it help? Well, it'll be debt-free post the IPO. That's point number one, so they'll save on some interest cost. There'll be operating leverage that will play out as well, because the capacity is going to be going up from around 2.5 lakh to around 6 lakh tons. And the third factor is the specialty steel vertical. Well, that's going to be commissioned, which will aid their margin profile. The margins for the company of the last year was close to around 6%. So from there, we should see some bit of an improvement. Put all these three factors together, and these are takeaways from what the management told us. The street is excited about the way ahead. Interest savings, operating leverage playing out, and they are changing their mix as well with higher focus on a higher margin segment.
Right, so that's about the new listing. Just keep an eye on a couple of consumer stocks which are actually doing well. We have Pidilite, which is still holding in the green in today's trading session. We have Raymond, which is doing well. Raymond's up 3%. Remember, there are a couple of brokerage notes. The management, decoded the whole strategy of the company, the demerged entities, etc. So there were some, details given out by the company. That's doing well. Honasa continues to do well, likely to grow the fastest in the consumer space in the first quarter. And Kaya, that's the one that's been on a tear over the last few trading sessions. This month itself, it's up 45%. And this is one of those stocks where every dip is bought into. Briefly, when the market fell, we saw the stock move into the red. But from there itself, there's been a recovery of almost 2.5-3%. So that's something we'll watch out for as well. But we spoke to Puneet Chhatwal of Indian Hotels yesterday, and did he speak about growth in this year? Yes, 10% is what they're looking at. And also, the average room rate may perhaps come lower from current levels, largely because they will add 10 to 12 Ginger hotels every month. So on a blended basis, it may be visible out there, but 10% overall revenue growth with increase in occupancy and holding on to the average room rates of the key brands with increased rates coming in from Ginger hotels is something that the company's strategy is. Let's hear him out.
The job of the management is to navigate through all kinds of headwinds. As in the past several years, I remain cautiously optimistic about the guidance that we have given. And the guidance that we have given is a 10% growth in the top line over last year with or without G20. We think we are on track. For the year, we did 33% almost. So I think anything north of 30 for the full year is a very good industry-leading margin on a global front. We should not forget we have also hotels in US and London and Cape Town, and it's not just a domestic. On the domestic front, on standalone, we are north of 40. And I think that's a very respectable and a very high margin for the kind of business that we are in. And we have been very confident in giving this guidance, and we stand by that. And if the growth of Ginger starts in the way we have been thinking it should, like adding at least 10 to 12 a hotel a month just with the Ginger brand, then it starts diluting the overall average achieved rate, because a Ginger brand would do like 4,000 or 5,000 rupees as an average rate, whereas Taj would do north of 15,000.
Well, time to slip into a short break. If we come back, we continue our focus on the markets, which are struggling as of now. We'll focus on select stocks as well. Don't go anywhere.
Welcome back. While there is nervousness across the board, some stocks are having some days out in the sun. You know, we have something like a Tips Industries, which has seen a decent move, has suddenly spiked to the high point of trade. But by and large, you know, the number of gainers are far and few in between. We have a lot of stocks which are actually currently at the low point of trade. Garden Reach Builders, for one, down around 4% as well. But let's take note of all that's taking place on Wall Street and the global cues that may affect our markets as well. Speaking to the Senate Banking Committee as part of his semi-annual address to the Congress Federal Reserve, Chair Jerome Powell cautioned that keeping rates elevated for too long could actually stunt economic growth. So let's hear that out first.
The Federal Reserve remains squarely focused on our dual mandate to promote maximum employment and stable prices for the benefit of the American people. Over the past 2 years, the economy has made considerable progress toward the Fed's 2% inflation goal, and labor market conditions have cooled while remaining strong. Reflecting these developments, the risks to achieving our employment and inflation goals are coming into better balance. Recent indicators suggest that the U.S. economy continues to expand at a solid pace. Gross domestic product growth appears to have moderated in the first half of this year, following impressive strength in the second half of last year. Private domestic demand remains robust, however, with slower but still solid increases in consumer spending. We have also seen moderate growth in capital spending and a pickup in residential investment so far this year. Inflation has eased notably over the past couple of years, but remains above the Federal Open Market Committee's longer-run goal of 2%. After a lack of progress toward our 2% inflation objective in the early part of this year, the most recent monthly readings have shown modest further progress, and more good data would strengthen our confidence that inflation is moving sustainably toward 2%. We know that reducing policy restraint too soon or too much could stall or even reverse the progress that we've seen on inflation. At the same time, in light of the progress we've made both in lowering inflation and in cooling the labor market over the past 2 years, elevated inflation is not the only risk we face. Reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering adjustments to the target range for the federal funds rate, the committee will continue its practice of carefully assessing incoming data and their implications for the evolving outlook, the balance of risks, and the appropriate path of monetary policy.
All right. Well, let's also listen into Ruchi Sharma, the chairman of Rockefeller International, talking about the U.S. economy and also his views on investing in the emerging markets, including India.
I think that the U.S. economy is slowing. This is going to be the second quarter in a row where growth comes in well below 2%. And I think that this trend is now seeming that it's going to go on. I won't be surprised if the U.S. economy comes to a virtual standstill in the next 6 months or so as the stimulus, which has, I think, kept growth artificially high, dries up. And I suspect that's what's going on just now. Investors currently are in the grip of the AI mania. So as long as that goes on, everything else gets shaded. So it's very interesting comparison that the US is outperforming, but it's almost all due to the mega cap tech stocks, particularly stocks like NVIDIA. But on an equal weighted basis, if you look at the US market or the European markets or emerging markets, the performance is pretty close. So I think that is just that one sector that's keeping the US outperformance going at this stage. Yeah, I think that India is a completely unique case on its own. As you know, it's the most expensive market in the world today. It's the one country, I would say, which is having a true bull market, even compared to the US, as you point out, that the breadth of the Indian bull market is what you typically see in bull markets, that everything is rising there, with mid to small caps doing better than even the large caps. But I will not say that geopolitics is a major risk for investing in emerging markets as such. I think that emerging markets at this stage outside of India, which is obviously very expensive, are extremely cheap. But this is a central issue which we are dealing with in the US, and I think we're dealing with global investing.
All right, so that's some interesting opinion coming in from Ruchi Sharma, saying that India is the most expensive market in the world right now. Not so much today, down about 1%, but we take it as it comes. With that, we're wrapping up on this edition of Chartbusters. You stay tuned to CNBC-TV18 Trading Hour. The team of Trading Hour will take the market action forward after this short break.